Hey guys, welcome back to another episode. In this video, I'll share with you a super simple and proven profitable price action pattern trading strategy with a high win rate. This strategy is very straightforward but incredibly effective at making the most profit in any market and under any conditions. So, after you've mastered this tutorial, you can leave behind the traditional methods of analyzing price action patterns that may still be confusing for you. But before we dive in, please hit the subscribe button and turn on the notification bell so you don't miss my latest videos. And once we've covered this special strategy, I'll also show you how to instantly boost your trading profits 2 or 3 times. So, without any more delay, let's go straight to the video. I call this strategy the non-lag price action pattern. As the name suggests, I use a non-repaint indicator to help you determine the market trend. This indicator doesn't repaint, which means that once it determines the trend direction, that decision won't be reversed. So, what's the advantage of using a non-repaint indicator like this? The benefit is that we can measure the accuracy of each signal generated by the indicator to determine if the signals it will produce in the future are likely to be accurate or not. If trading signals made in the past by a non-repaint indicator turn out to be highly accurate, then it's very likely that the trading signals it will generate in the future will also be very accurate. Conversely, if past trading signals from a non-repaint indicator were not accurate, then it's likely that future trading signals it generates won't be accurate either. Therefore, if we have a non-repaint indicator with high accuracy, this can significantly boost your trading success. Let's explore the advantages of this non-lag moving average indicator. As you can see, this indicator provides signals that change the color of the moving average line from blue to red, or vice versa, from red to blue. It's clear that the signals generated by this non-repaint indicator are quite accurate and can lead to significant profits when compared to losses from false signals. From just this information, you can conclude that this trading strategy will be very profitable and easy to apply, even if you're a novice trader. Okay, let me briefly explain this non-lag moving average indicator so you can fully understand why it's so special for both pro traders and novice traders. So, what is non-lag MA? The non-lag MA is an indicator that shows the lag-free returns of the widely used moving average. The non-lag moving average indicator is a custom moving average that does not lag behind the price. It also comes with trend detector features to reflect the changes in the bias of the trend. It changes to blue when the market is bullish and turns red in a bearish trend. So, essentially, the indicator can come in handy as a trend filter to filter out the market noises and also define the trend bias of the market. The non-lag moving indicator is an improved version of the regular moving average. It was carefully built with smoothing features that reduce price lag to almost zero, and it provides signals that don't repaint. This indicator is also highly responsive, which means it gives signals quickly. Despite being responsive, the non-repaint signals it generates are quite accurate. Price action candlesticks and chart patterns. Candlestick and chart patterns are important tools for every price action trader. Traders use these patterns to predict the short-term direction of prices. However, even though there are many candlestick patterns and chart patterns in my trading strategy, I only concentrate on a few patterns that have the highest chances of winning. So, here are the top 3 price action candlestick and chart patterns to trade in this non-lag price action pattern strategy. Here are the 3 candlestick patterns that are closely watched in the market. If you come across these candlesticks, it's a good idea to conduct a more detailed technical analysis because they could be the key to your treasure. Therefore, if you are serious about entering the trading business in the forex and stock markets, you should have a good understanding of these candlestick patterns. First, the pin bar. I'll briefly explain the pin bar here because our focus in this video is on a more comprehensive trading system involving various price action patterns. So, what is a pin bar? The pin bar, also known as a pin bar candlestick, is one of the most discussed price bars or candles in trading. This is because it can sometimes serve as a reliable signal that a significant price movement is about to occur, providing traders with an opportunity to enter a new trade with low risk compared to the potential reward. The pin bar itself has a long upper or lower tail and a much smaller body. You can spot pin bars on any naked bar chart or candlestick chart. Criteria for identifying valid pin bar patterns. Pin bars, despite having similar characteristics like a long tail and a small body, may look different when they appear on the chart. Determining whether a candlestick qualifies as a valid pin bar can be a bit tricky. Fortunately, there are 4 features that a candle must possess to be considered a valid pin bar. First, a long tail that extends beyond the surrounding candlesticks. Second, the tail can be either below the body, indicating a bullish pin bar, or above the body, indicating a bearish pin bar. The body should be closer to one end of the pin bar. Third, the tail should be at least 3 times longer than the body. Fourth, the nose should be relatively short. If the nose is too long, the candlestick will form what's known as a doji, which has a small body and equal length wicks on both sides. A perfect pin bar will have a very long tail and a very short nose. So, if you find a pin bar that meets these 4 criteria I mentioned earlier, you can apply this strategy to determine whether the pin bar has the highest probability for profit or not. Next, we'll discuss the second best candlestick pattern. The engulfing pattern. So, what exactly is the engulfing pattern? Engulfing candles typically indicate a reversal in the current market trend. This pattern involves 2 candles, with the second candle completely engulfed the entire body of the first candle. It's important to note that while an engulfing bar is technically valid if it engulfs just the candle immediately before it, the stronger the signal becomes when it engulfs more previous candles. There are 2 types of engulfing patterns: the bullish engulfing and the bearish engulfing patterns. First, bullish engulfing pattern. The bullish engulfing pattern is a 2-candle reversal pattern. In this pattern, the second candle completely covers the entire body of the first candle, regardless of the length of their tails. This pattern appears when the market is in a downtrend and consists of one red candle, followed by a larger blue candle. On the second day of the pattern, the price opens lower than the previous low, but strong buying pressure drives it higher, surpassing the previous high. This indicates a clear victory for the buyers. Second, bearish engulfing pattern. The bearish engulfing pattern is essentially the opposite of the bullish pattern. It's a technical chart pattern that suggests lower prices ahead. This pattern consists of an upward candlestick, followed by a larger downward candlestick that completely engulfs the smaller upward candle. The significance lies in the fact that it indicates that sellers have taken control from buyers and they are pushing the price downward more aggressively than the buyers could push it upward. So, if you come across either the bullish engulfing pattern or the bearish engulfing pattern, you can apply this strategy to determine whether these engulfing patterns have a high probability of being profitable or not. Next, we'll discuss the third best candlestick pattern. Third, ascending and descending triangles. Ascending and descending triangles are popular chart patterns known for their reliability and high success rate compared to other patterns. Ascending triangles usually indicate a bullish continuation pattern, suggesting that the price is likely to break above the resistance level and continue rising. The ascending triangle. A descending triangle is another chart pattern used in technical analysis. It's formed by drawing a trendline connecting lower highs and a second horizontal trendline, connecting a series of lows. A regular descending triangle pattern is usually seen as a bearish chart pattern or a continuation pattern in a downtrend. In this case, a breakout below the support line is a high probability signal produced by the descending triangle pattern. Now, from this brief explanation, you already know about 3 high probability price action patterns in the forex and stock markets. Next, we'll discuss how to apply these high probabilities to the non-lag price action pattern trading strategy. As I mentioned earlier, this trading strategy is simple but highly accurate. Let's move on to the trading strategy. Non-lag price action pattern trading strategy. Now that we know about the best price action patterns, let's discuss how to use these patterns in this strategy. As mentioned at the start of this video, we'll only be using one special indicator called non-lag MA. I call it special because it generates non-repaint signals, allowing us to assess the quality of the trading signals it produces. Based on my evaluation, the signals it generates have been quite accurate and have resulted in profits that are generally larger than the losses incurred due to trading signal errors. But don't worry, you can also verify this for yourself because I'll provide you with this indicator for your own use. Now, let's talk about how to use the non-lag MA indicator. As you can see on this chart, when the non-lag MA line changes from red to blue, it signals a shift in the trend from bearish to bullish. Conversely, when the non-lag MA line changes from blue to red, it signals a shift in the trend from bullish to bearish. At first glance, you might feel optimistic that by following these non-lag MA indicator signals alone, you can achieve maximum profits in the market because almost all of its signals lead to substantial gains. I don't discourage you from directly using the trading signals from this indicator or combining it with other indicators like RSI, CCI, or MACD as filters. However, the most effective approach that has proven to be highly profitable is combining this non-lag MA indicator with high probability price action patterns that I explained earlier. Now, I'll show you how to do that. Non-lag price action pattern trading rules. To help you master this strategy, I will explain it systematically with sequential trading rules. Bullish trade signal. In a bullish trade signal, the first requirement is that the non-lag MA line must be blue. As you can see in this chart, the non-lag MA line is blue, indicating a bullish market. Now, you just need to wait for the appearance of a price action signal to open a buy position. The condition for the price action signal is that it should be near the non-lag MA line. If the signal is a pin bar, then the non-lag MA line should be near the body of the pin bar or around its body. For example, in this case, we can see that the non-lag MA line is around the body of the bullish pin bar. This is a valid buy signal. After the bullish pin bar forms perfectly, we place a buy stop pending order above the upper tail of the bullish pin bar and set the stop loss below the lower tail of the pin bar. As you can see, the price quickly rises as of the time this video is made. Another example is the bullish engulfing pattern. In this chart, based on the blue non-lag MA line, we categorize the price movement as bullish. The next step is to wait for the appearance of a bullish price action pattern near the non-lag MA line. Here, we see the formation of a bullish engulfing pattern, which means that if this pattern forms perfectly, we should immediately place a buy stop order above the last bullish candle. Our stop loss is placed below the last bullish candle. As you can see, the result is a rapid price increase, giving you significant profits. Bearish trade signal. Similar to the bullish trade signal but in the opposite direction. In a bearish trade signal, the first requirement is that the non-lag MA line must be red. As you can see in this chart, the non-lag MA line is red, indicating a bearish market. Now, you just need to wait for the appearance of a price action signal to open a sell position. The condition for the price action signal is that it should be near the non-lag MA line. If the signal is a pin bar, then the non-lag MA line should be near the body of the pin bar or around its body. For example, in this case, we can see that the non-lag MA line is around the body of the bearish pin bar. This is a valid sell signal. After the bearish pin bar forms perfectly, we place a sell stop pending order below the lower tail of the bearish pin bar and set the stop loss above the upper tail of the pin bar. As you can see, the price quickly drops, providing us with significant profits. Another example is the triangle bearish pattern. In this chart, based on the red non-lag MA line, we categorize the price movement as bearish. The next step is to wait for the appearance of a bearish price action pattern near the non-lag MA line. Here, we see the formation of a descending triangle pattern, which means that if the price successfully breaks below the support line, we should immediately take a sell position on the next candle. Our stop loss is placed above the nearest swing high. It's proven that the price quickly continues its bearish trend, giving us substantial profits. Another example is the bearish engulfing pattern. In this chart, based on the red non-lag MA line, we categorize the price movement as bearish. The next step is to wait for the appearance of a bearish price action pattern near the non-lag MA line. Here, we see the formation of a bearish engulfing pattern, which means that if this pattern forms perfectly, we should immediately place a sell stop order below the last bearish candle. Our stop loss is placed above the last bearish candle. As you can see, the price then quickly drops, providing us with significant profits. From the examples we've seen earlier, I believe you can harness the power of this indicator. If you already have this indicator, you now possess a powerful tool to use with high precision, namely by utilizing the 3 price action patterns I explained earlier. But if you don't have this indicator yet, don't worry. I've made it available for you. You can download the indicator in the description. I've also included a template with the system that you can easily apply to your chart. It will automatically display all these indicators correctly on your charts, so you don't need to worry about anything. Get the download link in the description. As always, If you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.